Let's talk about whether or not this massive rally over the last 6 months in value sectors like financials is already pricing in a very optimistic earnings season.
Well, one could certainly say that, but if you look at how much they got destroyed in the first part of last year, the move does not reflect this very large GDP increase we're going to see in the back half of this year, steeper yield curve, which is much steeper than it was at the same time last year, as well as potential for a lot of loan growth in the back half of the year. I think the stimulus has been incredible. It's amounted to 42% of GDP. The economy is awash in liquidity, and the banks are awash in deposits. They need to be able to deploy those, and that's the growth story of the second half of the year for the banks.
So if that's the growth story, are there certain parts of the financial complex that will do better than others? I mean, when we talk about financials, it could be insurance companies, it could be regional banks, it could be money center banks, it could be investment banks. We've got an interesting cadre today, right? Because you've got a money center bank in JP Morgan, you've got a traditional lender in Wells Fargo, and you've got an investment bank in Goldman Sachs. Among those three, which one of those is your favorite?
Sure. I really like self-help stories. So Wells Fargo is a self-help story. There's a lot of improvement to come there, a lot of cost cuts to happen. There'll be noise in the quarter, but the stock is cheap relative to the other banks, and there's a lot more to come there. And eventually, when they get out from under the asset cap, the earnings can explode to the upside. They've been doing everything they can to appease regulators and behave. And just by the by, if they ever let them out of the cap to grow assets, they're capable of buying $200 billion of U.S. Treasuries. It helps fund a deficit when the other big banks may be a little more constrained given the SLR.
So we've talked about you mentioned the SLR. There are constraints here that the banking industry will face in the coming months. What do you think is going to be the biggest factor, that kind of caps what financials can do in the medium to longer term? I don't see a lot of cap on the regional banks right now because I think that loan growth is going to be there. So, if I'm right and GDP is in the upper middle single digits, that's great. If we close back down again, that's the cap, right? That is the real risk to, the market, to financials. We need the economy to stay open and keep reopening. And there's a lot of momentum here right now. As a banking analyst, when you talk about things like that, like interest rates, like net interest margins, like the yield curve, there are factors there that you consider. How much are you as an analyst looking at forecasting for rates? And then how much does that factor into how you feel as though you will allocate capital to certain investments? Are you doing it more to regional banks because you think that interest rate picture gets even better for them down the line? How exactly then do you go about your process in picking which are going to be the outperformers?
Sure. Yes, I'm definitely allocated to regional banks at this point because I do expect that loan growth to happen. I do expect more mergers to happen and costs to come out of the industry. We're way over branched in this country, so costs is a big factor. And banks have learned that everybody's moved, to the internet, whether it's businesses or senior citizens. Everybody's logging in, so they don't need the same amount of branches and the same amount of resources there. So that's important too. That cost story, I think, is one that's going to develop over time. Not today, but it'll come. I also look at another sector. I love M&A, and I love it not only for the banks, but I also like some of the boutiques. I think all the big banks today, JP Morgan has big unit, obviously Goldman, they're going to report really robust M&A, really robust capital markets. And, one of the flies in the ointment has been the SPACs, right? All of a sudden, SPACs, you can't IPO them. But all those SPACs that are out there have all this cash, and they've got to put it to work within that 2-year ticking clock. You're going to see a lot of acquisitions going on, a lot of advisory fees come into some of the broker dealers, and not only just the big ones, but I happen to like Cowen. I happen to like Jeffries. I think they'll be major beneficiaries of that, and they're incredibly cheap relative to their earnings prospects. So I think those are neat as well.
Shepard Smith here. Thanks for watching CNBC on YouTube.